Good afternoon, and welcome to today's Contractor Magazine webinar, Understanding the Numbers in Plain English. My name is Bob Mader. I'm the Editor-in-Chief of Contractor Magazine. I'd like to take a moment to thank the sponsor of this afternoon's webinar, Sage Peachtree Quantum. I'd also like to remind all of you that if at any time you experience audio difficulties or advancing the slides, simply press your F5 key to refresh your webinar console. I would also like to encourage all of you to ask our panel questions. As a question occurs to you, simply type it into the box on the right-hand side of your screen, and we will be addressing as many of your questions at the end of our presentation as we can. Now, let me introduce today's presenter. Leslie Shiner has more than 20 years' experience as a financial and management consultant. She is the owner of the Shiner Group, a consulting firm helping contractors gain financial control of their companies. As a business coach, she has worked with both small and large businesses to help them better understand their business practices and maximize their profits. She is the author of numerous publications that focus on the construction industry, including A Simple Guide to Turning a Profit as a Contractor. It's my great pleasure to introduce today's speaker, Leslie Shiner. Leslie, the floor is yours.
Thank you so much, Bob. I appreciate that. And I'm really happy to have this opportunity to talk to you today about understanding the numbers in plain English. You know, it's hard to run a business, and most business owners got into the business not because they love numbers, but because they love whatever it is they do. And typically the technical skills that got you where you are today are not necessarily the business skills that you need to get you where you need to be tomorrow. So I'm going to go ahead and start advancing through the slides, although it looks like I may have lost internet connection, so you'll let me know if that's not working. But anyway, as Bob said, my name's Leslie Shiner. I have written a book called A Simple Guide to Turning a Profit as a Contractor. I write for a couple of different magazines, and I have an MBA in accounting and finance from UC Berkeley, and then I'm also a Sage certified consultant. But enough about me. Let's talk about you. Let's talk about what questions are you asking yourself numbers-wise for your business. What questions are you asking on a day-to-day basis? And these are the questions to ask. First of all, how much money am I making in my company? Sort of as a sub-question to that, how much money am I making on each job? So what I find after working with contractors for over 20-some years is that most contractors really know how much money they're making on a job in terms of gut-wise. However, the problem is that that's usually about corrected for about the first 70-80% of the job, and then those numbers start to fall apart. Or when there's lots and lots of jobs, then those numbers also start to fall apart. So the question is, do you have empirical evidence that tells you how much money you're making for your company, not just how much money is hanging out in the checking account? And do you have empirical evidence that says how much money have you made on each job? The other question, the second question, is how much money, not only how much money am I making, but where am I making money and where am I losing money? Like what part of my jobs, what part of my business is profitable and what part isn't? And we'll get into that. Third question that always gets asked, and people ask me this all the time, am I charging enough? How do I go about setting my billing rates? Am I charging enough for my labor? Am I charging enough for equipment? And then the fourth and final question to ask is my profit number a real number? And I think in many companies and in many small to mid-sized contractors, that's not necessarily the case because the numbers are maybe lying to you. And we're going to talk about why or so that happens in your company. So my question to you is, do the numbers bore you? Is this what you look like when somebody tells you to take a look at your financial statements? Or for some of you, you just might have given up. Have you given up? Is that what you look like when you're looking and sitting at your desk? It is important to understand from a business perspective what the numbers mean and how they can help you run your business. There's a book that I actually read and I recommend. It's called Mastering the Rockefeller Habits. It actually has very little to do with accounting. Most of what it talks about is the rhythm of companies and how to do meetings and how to set goals, and it's a great book. But I quote from this book because I thought one of the best things I heard him write or saw him write in this book is that there's really three fundamental activities at the heart of every single business function. The first one is you got to make or buy something. You go out and you buy equipment. You got to make it or buy it. Typically, we buy it in our industry. Then you turn around and you sell it or you install it. Those are the two things that most everybody does for a living. But he said the third fundamental activity is to keep good records, and that's what's so important. I can go out and buy stuff and then sell it, but if I'm not buying it and buying it for less and selling it for more, then I'm not making money, and it's only through keeping good records that we can find that out. So that's what's so important about write things right. And we're going to start off right off the bat. We're going to open up a poll. And, Bob, you want to go ahead and read the poll, and let's see what we come up with our audience.
Okay, ladies and gentlemen, here's the first poll question we have. Do you regularly analyze your financial statements? And your options are yes, all the time, yes, sometimes, no, but I know we should, and no, it doesn't really seem to make any sense or matter. So please check off whichever box is appropriate and submit your answers. Leslie, I would imagine you have a lot of experience in this.
Well, I'm hoping. We'll see what the answers are.
Yeah.
It depends, and I want to also remind people. There we go. We've got those answers, and gee, what do you think? We've got about a third of you saying yes all the time, which is great, and a little more than a third saying yes sometimes, and about another third saying, no, you don't do it, but you really should. So, what do you think about that, Bob? Is that what you would have expected?
Yeah, well, I'm really heartened by the zero saying no, it doesn't really seem to make sense or matter. Although I know the 29.7% that says no, but I know we should. I hope they're paying attention because we can help them out today.
Yeah, great. So yeah, I think that's a very good assessment, and I do appreciate it. And I'm actually quite pleased to see that, if you add the yes all the time and the yes sometimes together, you're at 60, 70 something percent. So I think that's pretty good, 70% doing that. So that's great to take a look at. Let's go ahead and push those poll results. I'm sorry, we needed to push those results. You guys weren't seeing that. So there we go. Okay, so then let's just the numbers changed a bit. So we can push those poll results to the audience. And you can see now it's already up to 45% saying yes sometimes. So a couple of people answered a little bit more. So sorry, I was just trying to play with the technology. So you guys should see the poll results. So let's keep going. Let's talk about the first question, which is how much money am I making? So you need to look at the income statement, also called the profit and loss statement. And one of the things that happens is I think many business owners only look at one number, and that's the bottom line. That's the one number that a lot of business owners look at. And I don't think that's enough. We're going to look at a couple of examples as to why that's not enough. The income statement provides more information. It provides your gross margin. It provides your overhead over time. And those are certainly things that you need to be taking a look at. But you also have to take a look at the balance sheet, because the balance sheet is a couple of things. One, it's sort of a snapshot of where your business is today. And what's most important is that errors on the balance sheet will mean errors on the income statement. You cannot make good business decisions if the information that you're looking at is wrong. For example, I have a client, and I always like to joke with my clients, and I say, I'm the psychic accountant, because I'll take a look at a set of financials, and I'll sort of hold it up to my head. I'll steal from that TV show. I'll hold it up to my head, and I'll say things like, I get a feeling it starts with an S. It starts with an S. Your sales tax is off, and your profit is about $400,000 less than you think. And I did this with a client of mine because he showed me a set of a P&L, and it said he made $1 million last year net profit. And he said, I know we had a good year, but I can't imagine it was that good. And I looked at his financial statement, and then 2 seconds later I said, your sales tax is wrong. So oftentimes clients will say, well, how do you know? How do you know that? And I said, financial statements have to speak to you. They tell you stuff. Things that look wrong are wrong. What his company had been doing is collecting sales tax and calling it income. And so whenever he was collecting sales tax, he was calling it income, so he was double counting his income. The way I could tell is he had an account on his balance sheet that was called sales tax payable, and it had a negative balance. So very important that the balance sheet is read as well as the P&L, because the balance sheet is where it's going to tell you there are things wrong with your financial statements. When we look at a P&L or an income statement, it's called a multi-step statement in our industry. And in essence, we separate out our costs into two types of costs. One is what we call above-the-line costs, or cost of goods sold, COGS, stands for cost of goods sold, or anything that's directly specifically related to jobs. And then those that are below the line, those are called overhead expenses. And it's important that we separate out those two types of costs, and we're going to look at some of those examples. COGS stands for cost of goods sold, and as I joke with many of my clients, it also stands for cost of goods stole, if you think about it. So there's some profit and loss issues, and the biggest profit and loss issue in our industry is the fact that the P&L doesn't match the time frame of all the jobs that you're doing. You've got a profit and loss statement. It is arbitrarily picked a starting and an ending point. For most of you, it's probably January 1st and December 31st. That's usually the starting and ending point if you're on a calendar year. But January 1st isn't a magical number. There's no law that says all jobs have to end by December 31st and can't start until after January 1st. What it means is that you have to be able to look at your financial statement and say, how am I going to measure the jobs that I'm working on right now? So that's one of the biggest problems with looking at a P&L is it has this weird cutoff. I got half of this job, 20% of one job, 3% of another job. I got a deposit on a job, but I haven't started it. I finished a job, but I got paid last year. All those things make that P&L difficult to read unless you start analyzing it appropriately. The other issue is revenue recognition issues. Are you on a cash basis or are you on accrual basis? I say if you are on a cash basis, it may be better for taxes, but it's very important. If you want to get a true handle of where you're at, you are doing accrual-based accounting, meaning income is income when it's earned, not just when the check is received. And then again, I mentioned the expenses about above the line versus below the line. If you can be clear on your time frame, have a good accrual-based system, have a billing method that matches the ability to recognize revenues appropriately and clearly distinguish above and below the lines. If you are clear on all of these issues, then when you look at your financial statement and it says you're profitable, then you can believe the numbers on your financial statement. They are accurate. So you have to be clear on these issues to help determine your true profit. So you look at your profit on your whole company as a whole. You also want to take a look at the profit of your jobs individually. And that's where it's so important to have a gross margin and track your gross margin. In essence, the gross margin is calculated by income minus cost of goods sold. Take that gives you your gross profit. Take your gross profit divided by your income. That's your gross margin. What is your gross margin? Your gross profit has to be enough to cover overhead, and you have to take a look at the gross margin for the company as well as the job. So let's just look at something. Let's just take a look at a company. Which company looks more profitable? We got company A, income $400,000, cost of goods sold $250,000, has a gross profit $150,000, gross margin of 38%. Look at company B, their cost of goods sold are higher, their gross profit is lower, their gross margin is lower. So most of you are probably saying, wow, company A looks like it's more profitable. Absolutely. However, if you just follow the numbers all the way through and you take a look at the overhead, now you start looking, well, maybe company B is more profitable. Company B actually has an 8% net profit, while company A only has a 3% net profit. And the reason is company A is throwing a whole bunch of junk in overhead, like the payroll burden, like all that stuff. Company B is more accurately representing the cost of goods sold. They're including the burden for the payroll. They're including a bunch more costs in here. So in essence, their overhead is actually less. and they're actually making more money. They're just classifying it differently. And I think this is important to look at that because I think it's very important that you have an accurate gross margin. I was part of a benchmarking survey that was done by a trade association, and people filled out their financial statements, and one company filled out the financial statement. They had an 80% gross margin. Woohoo! An 80% gross margin. Well, that means one of two things. One is they have learned the secret to selling at a credible markup that none of us have figured out yet, or two, they have no idea what they're doing, and I think it's actually number two. Basically, they don't have anything below the line. They probably have all their labor below the line, everything. The only thing they're showing in their cost of goods sold is perhaps some direct equipment they're buying for a job. It means their financial statements are lying to them. So it's very important that you don't overstate your gross margin. This company with an 80% gross margin might have 95% overhead. So as we come through here, we want to say,
Uh-oh.
a profit and loss statement. If you think about it, what you can do is segregate out your materials and your equipment revenue from your labor revenue. And that way you're tracking the costs and the revenue separately, and you can start analyzing and saying, how much money am I making on my labor and how much money am I making on the equipment that I sell? This is really important for those of you that have small jobs, large jobs, a service component. Service component to your work, high on labor, low on equipment. Jobs, typically higher on equipment, lower on labor. And if you're not segregating out and knowing how much profit you're making on each, or gross profit you're making on each, as you move between volume changing between service versus jobs versus contracts, you may end up finding that you're losing money. Some companies have a huge service component. They don't realize it, but they lose money on service because they're not charging enough per labor, and the overhead to run a service component is much higher than contract work. And then all of a sudden their service picks up, their contract dies, and then the company has no profit. They thought they were profitable, but service wasn't the profitable part. So it's really important to measure your gross margin for just the equipment. What are you installing? What type of equipment are you buying? What are you pulling out of the warehouse? Are you losing money on warehouse equipment? Do you have a bunch of stuff that sort of disappears and walks out the door? Are you managing your financials for just the equipment that you sell? And then the installation on that equipment, are you managing your financials and figuring out for the labor component of what you're installing? And as I said, take a look at your profit center and the profit analysis on a job type by service, by equipment, by small jobs, large job, by contract price versus T&M. And the only way to figure that out is to start looking at a parallel financial statement that gives you that information. Here's an example of a parallel financial statement. Something happened to that slide, but that's okay. So we're looking at the income. 65% of my income comes from equipment sales. 35% of my income comes from wow, something happened with that slide altogether. Okay, that's interesting. So labor and subcontractor income is $350,000. That's about 35% of my total income, and equipment is about 62%. Well, that's interesting. My costs are 44% of my costs are equipment. 62% of my revenue is equipment. In fact, what I can start doing is taking a look at my gross margin. So if my labor and equipment, if I sell $350,000 worth of stuff just on the labor and subs, and it costs me $195,000, then I'm making about $155,000 just as my gross profit on my labor and equipment. That's $155,000. Divide that by 350, I'm making a 44% margin, a 44% gross profit. So my equipment is not as profitable as my labor. So by creating a parallel financial statement, you can start to see what's more profitable and what's less profitable. And again, if you have questions, feel free to pop them in the Q&A, and we'll make sure that we have time to cover them. Again, this isn't a full-blown accounting class. I don't have time to, you guys don't have time to sit through it, and you don't want to sit through it because accounting is boring. I get that. But what we're trying to do is just sort of look at the highlights. What are the meanings behind the numbers? You know, the joke about, how do you make $2 million in our industry? And the answer is, how do you make $1 million? I blow the punchline. How do you make $1 million in our industry? You start out with 2. After you lose $1 million, you quit. I'm hoping that's not the case. You guys are running good businesses. You're running larger businesses. You're really trying to get a true understanding of what's important and what's behind those numbers. Oops. If we take a look at, got to get to the right slide, above the line versus below the line costs. This is really important. It goes back to my guy who's making an 80% profit. He's got all his costs below the line. Overhead is the only thing that belongs below the line. It's typically fixed. It doesn't really fluctuate with volume. What's above the line is the cost of goods sold, costs specifically related to jobs. So you've got to be very careful. Some of you, or many of you, probably have inventory, and a lot of companies I see don't handle inventory correctly. I had a company whose inventory grew. They were a plumbing company. Their inventory grew by $10,000 every month. That means that they were carefully buying stuff, putting it into inventory. You go out to the warehouse, they aren't having actually physically $10,000 worth of stuff more. I didn't say that right. More, their inventory wasn't physically growing, but financially on their income statement it was growing by $10,000 a month. What did that mean? Well, first of all, we look at the balance sheet, and I noticed that the inventory is growing, and I asked the owner, are you buying more stuff? Are you building up the quantity of stuff you have in the warehouse? He's like, absolutely not. It's pretty consistent. What that means is somebody's really good at putting the stuff into inventory, but people aren't as good as telling somebody how to get the stuff out of inventory. Inventory is kind of funny because it's easy to put stuff in. You buy stuff, you put it in. The problem with taking money out of inventory is that somebody has to tell somebody something, or you have to automate it. When you have an automated process, then when something walks out of the warehouse, then you're going ahead and you're job costing it. Now you can know that it's gone. So this company with $10,000 a month of growing inventory, at the end of the year, what did we have to do? We had to fix their inventory. We had to reduce the inventory by $120,000. The other half of that entry, because accounting is a double entry accounting system, the other half of that entry means we increased cost of goods sold $120,000. Profit disappeared, $120,000 came out of the profit. Luckily, we knew all along during the year, and I had been warning them, but can your financial statement take a $120,000 hit? Probably not. So that's why it's very important to know what's a cost of goods sold. Anything that you pull out of inventory is a cost of goods sold. Anybody who works on a job is a cost of goods sold. Field labor belongs above the line. It's a burden. The labor burden itself is a direct expense. What we have to do is figure out how much does it cost to really do a job. One of the things I work with clients is you got to set up the true cost of performing work, and it will at some point in time reduce your overhead. One of the jokes I have is that as a business owner, I'm not really good at marketing because if I want to, sell you some great services, I can go ahead and walk in and say, hey, the best thing I can do is I'll increase your cost of goods sold and I'll reduce your gross margin. And somehow I never get hired. Why do I want to reduce your gross margin? Because what I want to do is I want you to really know how much it costs to do all the work that you're doing. It will make your work more expensive, but the other half of that is it makes your overhead less expensive. So you can really understand the true cost of the jobs, then worry later about the markup. You're not going to have to mark it up as much because your overhead is lower, your job costs are higher, and your net profit in the beginning will be the same, but you have a better understanding of how much it costs to put to put someone out in the field or to actually run a job. The question you want to ask is, am I charging enough? Are you job costing your jobs with all of the labor and the labor burden? Let's figure out how much it costs, and just taking a look at something like labor. How much does it cost to take an employee, stick them out in the field? How much does it cost for your technicians to be out in the field? Well, you got the gross pay, and then we have all these other things. We got payroll taxes, workers' comp, liability insurance. Do you pay health insurance? Are you union? Do you have any union costs? Do you do any sort of pension 401k? Do you pay for vacation and holiday and sick? All of these things really should be included in the cost to take your employees and put them out in the field. In fact, I always equate employees, especially field employees, to Pigpen. Do you guys remember who Pigpen was? Hey, Bob, do you know who Pigpen was?
It's Charlie Brown cartoons.
Absolutely. What did Pigpen have when he walked around? What did he have behind him?
A dust cloud.
A dust cloud. I'm not saying that your employees are dirty. That's not my point. My point is when you take an employee and they leave the office and they go out in the field, there's a dust cloud of costs that follow them wherever they go. Workers' comp, liability insurance, vacation, all of these costs go with your employees. In fact, you think about things like cell phones. Here's another example. Have you thought about, you know what, before we get to that, let me see, that's in a different spot. Oh, well, that's okay. Let's go ahead and ask you a question. How do you go about setting your billing rates? Go ahead, Bob.
And here are the options. Your gross wage plus markup, the burden wage plus markup, the analyzed labor cost with burden, or whatever the market will bear. So please answer that and hit the Submit Answer button.
And then we'll also just put in a note that says, or I'll just put in a plug that says, if you do have any questions while you're thinking about this, go ahead and just type them in the Q&A. We'll get to them at the end of the session. But go ahead and start looking at typing in some Q&A if you have any questions. So interestingly enough, Bob, what do you think the answer is going to be?
I would guess gross wage plus markup. Well, let's see what the answers are.
Yeah, let's go ahead and see what the answers are. Okay, so, and I assume that we've pushed that and the audience can see that. So we've got, oh great, 34% of you are doing a burden wage plus a markup. And I understand the almost 20 of you that are looking at what the market will bear, because ultimately, you can come up with a number, and if it's way too high, then you will change it to what the market will bear. But if what the market will bear is less than your labor cost with all of your burden, then you are, in essence, going to be in trouble. If it cost you more than you're charging, you're going to be in trouble. So here's a question for you. So have you guys thought about small tools? I'm looking at all the different costs that it takes to run a business and all the costs that are sitting in that cloud of dust that follows your employees wherever you go. Have you thought about small tools? I'll tell you, I had my windows replaced. I had a replacement contractor come in and replace all my windows in my house a couple of years ago. And the guy was a pretty good salesman. He talked about all the, benefits of energy savings and how nice it would be to have, these better windows. He was a pretty good salesman, but he wasn't as good as he could have been because he didn't tell me that apparently in this company, with every window replacement, they throw in a free ladder. And this may be some of your customers might be happy to realize that you throw in a free ladder every time you go out and visit their offices or visit their homes. In terms of looking at small tools, here's a question for your third grader. If 20 employees can lose $8,000 worth of tools, what would 25 employees lose? These are all costs. These are all the costs that belong in that cloud of dust that Pigpen carries with him wherever he goes that goes out to your job costs. It's really important to consider all of the costs that have to do with your running the jobs, the variable or what we call the indirect direct costs of taking somebody and putting them out in the field. Things like cell phones. If you hired another person, you're going to go out and buy another cell phone. And what's going to happen to your cell phone costs? What about vehicles? How much does it cost to give another employee a vehicle? Small tools, consumables. What about unbillable time? If you take a look at the time, do you guys have safety meetings? Do you pay for sick and vacation? Are there trainings? Do you send employees to trainings? Or do you have, are your employees sitting and listening to this webinar? What type of education and certifications do you have? These are all costs that have to be covered somehow, and they are all costs that belong to an employee. Vehicle is a great calculation. I've sat down with many companies, and I work with companies all around the country, and I've play this math game to try and figure out the vehicle calculation. Figure out how much it costs to take an employee with a vehicle out in the field. Look at the total cost you spent last year on fuel, maintenance and repair, fees, depreciation. Then take a look not at the total hours that you paid your employees for. How about just the total hours that they worked in the field? And if you divide the two numbers, you're going to come up with $1 per hour to have a field vehicle. And I will tell you the cool thing about this is that when I do these numbers with different companies, and again, companies all around the country, I often pretty much come up with the same number, somewhere between $3 and $5 per hour for a vehicle. I mean, that's a lot of money if you think about it. $3 to $5 an hour to add to the cost of taking your employees and putting them out in the field. What else do we want to take a look at behind the numbers? I'm trying to figure out, am I making enough money? Where am I making money? Am I charging enough? Well, one of the things to consider is you may have with your employees some hourly costs. You also can have monthly costs. And one of the problems that happens is, when it comes to monthly costs, is people figure out an hourly basis for a monthly cost, but the monthly cost is fixed. So let's say we got somebody whose health insurance is $840 a month. It's costing us about $5 an hour. Okay, that's $5 an hour for health insurance. I get that, and I understand that. But the problem is, what happens if the employee is only billable 25 hours a week? What happens if you have safety meetings? What happens if the employee only works 10 hours that week? They take off their time. They don't get paid for that. They're hourly, so they're saying, okay, I can only work 10 hours this week, only pay me for 10 hours, but you still have to pay 40 hours worth of health insurance. And so then all of a sudden we go from $8 an hour. It's costing us, look at these numbers. These aren't, let's see, $200 divided by 40 was $5 an hour. Now it's costing us $8 an hour. That's a lot of money. That's a lot of money that we can have to somehow recoup. So here's an example of a labor burden calculator. And I'll actually have my website up at the end of the slideshow. And if you want to, it's actually free that you can download this very simple. It's a very simple. We have different labor burden calculators. We have a free simple one that you can request on the website. But in essence, you start out and you take a look at some of the numbers. Look at the costs that are a percentage of the wages, things like Social Security and Medicare and workers' comp liability insurance. Those are all percentage numbers. So we look at that and we start putting those in. Then we start taking a look at some numbers that may or may not be flat. So things like health insurance, cell phones, that sort of thing. The other thing I've done here is I've created what I call overhead per full-time equivalent. I'm actually trying to burden my employees with overhead because I want to see how much it really costs. If I burden this overhead with to my employees, how much does it really cost to have my employees work out in the field? So I put it all together, and here I have an example of a chart, and you probably can't see the numbers, and that's okay. I'll just show you that I've got somebody that I'm paying $25 an hour to, and burdened, it's costing me $50 an hour. Well, you can say, okay, that's fine. I'm billing out at 85. I'm billing out at 110, whatever your number is. Okay, it's only costing me $50 an hour. But that's $50 an hour per hour that I pay them. It's not looking at what we call utilization. So the secret behind the number is not only to take a look at the number of hours that you pay for somebody, but take a look at the number of productive hours, the hours that they work. In this example, my guy isn't so productive, and I wanted to just show you. I paid him last year 2,000 hours, but he only billed, I think it's 1,100 hours. So I paid him for 2,000 hours last year. He only billed 1,100 hours because he's got a bunch of shop time that doesn't get billed to the jobs. Maybe I don't even bill driving time to jobs. Again, depending upon how I set up my numbers, I only have him billable at 1,100 hours. And with that, that's called a 55% utilization rate. And with that, it cost me $92 an hour. $92 an hour to take that employee and put him out in the field. Wow. That's kind of high. What do you think, Bob?
From from what I've heard because I go to all the seminars that contractors should be going to, that number does not surprise me at all. Contractors really need to be aware of that and charge accordingly.
Right, and the funny story is there's a lot of contractors who started out their own business because they were paid $25 an hour, they were billed out at $85 an hour, and they thought, wow, my boss is making money hand over fist, being able to pay me only $25 an hour and bill me out at $85 an hour. I'm going to do it myself. And a lot of small business owners started out that way. And the funny thing is that I always joke, in America, you can make a lot of money the first 2 years of business, because when you originally were being paid as an employee $25 an hour, now you're billing yourself out at $85 an hour. It's odd to note that many small businesses who begin in the first 2 years, there's no taxes and no insurance. But once your business becomes legitimate, you got to start paying taxes, you got to start paying insurance. I don't recommend having no taxes and insurance. That's not the best business practice. And then you start realizing that boss who paid you $25 an hour and billed you out at $85 wasn't really raking in the money and sleeping on beds of money every day and piles of cash. So yeah, I think it's very important to look at those numbers and to really understand those numbers. So we looked at a couple of different questions that we asked. The first one was how much money am I making in my company, and I want to make sure I have time for questions. Another one is where am I making my money? What part of my jobs are profitable? The third is, am I charging enough? And really important to decide, are you charging enough for labor, and looking at your gross margin? And then the fourth, I think most important, or just as important number is my profit number real? One of the things I see is a lot of companies, I'll look at a set of financials. One year they're really profitable, the next year they lost a lot of money. The next year they're really profitable, the next year they lost a lot of money. Is that because the first year they figured it out and the second year forgot how to run a business? Or is it because quite often they end up not having accurate financials, so that there's a whole bunch of revenue in one year and a whole bunch of expenses in another? So this is what's called a profit and revenue recognition issue. And the question is, when do you recognize, when do you show income on your financial statements? When did you actually earn the money? Did you earn it when you invoice the customer? Did you earn it when you actually get the cash? Or did you earn it when you actually did the work? And what becomes important is to realize that you should have it show up on your financial statement that you earned it when you actually did the work. And that's what's so important, to have accurate financials that you can start using to manage your business. In fact, here's an example. Here we got a job. It's a small job we're doing. We were 2 months into this 3-month job. The job started in November. We had some money coming in and going out in November and December. At the end of the year, this job looks great. We got $34,000 of income, $15,000 of expenses, a gross profit of $19,000, and it's a 56% margin job. We are really profitable. We look great. That's spectacular. But when you base your profits on when you send out invoices, you can get in trouble. So I want to walk you through this. We looked at the first one. The first 2 months, we had that job, was very profitable. Unfortunately, in January, we had to finish it. We didn't have a bunch of money coming in. We did have a bunch of money going out, and we lost money in January. I always say that contractors would be a whole lot richer if they only had to do 80% of every job. If you only had to do think how much money you'd make if you only did the first 80% of every job. If you look at this, the issue is this job actually was profitable. This job actually had a 40% margin. That's a good job, but it didn't have a 56% margin. What would have happened if you had paid bonuses at the end of the year? In the previous example, you had a 56% margin. You thought you were doing great, but in January you lost money. And this is why the issue has to do with you have to have a true and real profit number. And the only way to get a true and real profit number is to use something called the matching principle. Percentage of completion accounting, utilizing work in progress. WIP stands for work in progress. In essence, you've got income and expenses for the same activity during the same period. So in one particular month, if I did 40% of a job, I can show 40% of the expenses, and I can show 40% of the income. None of this recognizing or showing 40% of the expenses and 80% of the income on that job. And the only way to do that is, well, there's a couple of ways, but the way I recommend is to do what's called a WIP, or work in process, or work in progress adjustment, or schedule to find the adjustment. It's really the only way to have usable financial statements. It's going to smooth out that sort of fluctuation so that you don't have a huge profit one month, a huge loss the next month. You start looking at finding ways to recognize the true profit, and now all of a sudden your income statement shows what did you actually earn, not what did you bill. Here's an example of a WIP, an Excel spreadsheet. Here's just an example of a spreadsheet that you could have or you can use. And again, I realize it's small and I'm not asking you to look at it, but in essence what we're doing is we're trying to figure out what's our true profit so that we can adjust our financial statement. In fact, here, let's run through some numbers. Let's take a look at a job. Here's a company. We've got a job where you build, in fact, let's look at this. Here's two different jobs. One was in what's called overbuild. The other's called underbuild. Both columns show that we spent $49,000 on a job. We spent $49,000 on this job. First column, we billed out $90,000. We look great. The second column, we billed out $55,000. We don't look so hot. If we ran through and did a work-in-progress adjustment, and I'm really hoping you guys do this on a regular basis, what we would end up doing is we would whip out the income. We adjust the income so that in the first example we were overbilled by 20 grand. We're going to subtract 20 grand from our income. In the second example, we were underbilled by 15. We're going to add 15 to our example so that all of a sudden we have a consistent gross margin, and even if we were overbilled or even if we were underbilled, we adjust it with this WIP adjustment so that the correct gross margin is 21%. That way we've got the information so that we can now see our consistent gross margin over time. It's adjusting our work in progress and adjusting our revenue so that if we're overbilled on a job, we're taking money out, and if we're underbilled on a job, we're adding money back. In fact, let's do a quick poll as we wrap up this session. What do you think, Bob? Should we ask the folks this question?
Let's do it. WIP stands for where is profit, we install product, or work in process. Please check the box that you think is the correct answer and hit the submit answer button. And Leslie, I got to tell you, I'm looking at the questions we're getting from the audience. We're getting good questions.
Well, good. We're almost done. And so this was a quick poll. It was just a poll to make sure you guys are listening and having a good time, because that's what we want to do. We want to have a good time. So let's go ahead and show the audience what the answers are. Hopefully you've answered it, and good for you. A couple of you wanted to put in the joke answers, but absolutely it stands for work in process. So what we looked at is, oops, let's do this. Whoops. Sorry about that. Got to get the right screen here. There we go. So we looked at how much money are we making for the company as a whole and on each job. We looked at how can we figure out how much money we're making and why. Are we making it on equipment? Are we making it on labor? Are we charging enough for our labor? Are we charging enough to make a profit? And then when we do see a profit, is that a real number or is it just a timing issue? Is that profit just because I created a bill? You know, I got two companies. One company is aggressively billing. They're going to look more profitable than the other company that's not aggressively billing, or is it just a timing issue and we will adjust out that difference through a work in progress or work in process adjustment? So with that, we're going to wrap it up, and I hand it back to Bob. I do want to thank Sage Peachtree Quantum for giving me the opportunity to do this, and we do want to answer a bunch of questions. So I'm going to turn it back over to Bob. But again, I do want to thank, actually, Bob, I want to thank you, and I also want to thank Sage Peachtree Quantum for letting me sit here and yak for a bit. So I'm going to turn it back to you, Bob.
Okay, thank you, Leslie. Now, I've been doing this for a long time, and Michelle Skeel asked the age-old question, how do we compete with area companies who routinely charge less than our bids? We know what our materials and labor cost, and we can't understand how their bids can be so much lower.
That is a great question, Michelle. And as I'm about to start answering that question, what we do want to do, I think, Bob, is send people to do a feedback before we get to the Q&A.
Okay, while Leslie is answering your questions, please take a moment to answer the feedback form that will appear on your screen. If you have a pop-up blocker, we ask that you disable it so that you can receive the form.
Great, thank you. So there you go. Let's go ahead and answer Michelle's age-old question. You know, Michelle, I don't have the perfect answer to that. What can you do about companies that you know are lowballing and are basically going to be out of business, are basically ending up, in essence, having bids that are astronomically low? You know, it's interesting because I get this question, and I actually wrote an article for a magazine about lowering your price. We can consider lowering our price, but at the same time, price issues were very important 10 years ago, but they weren't as important. There was always a lowball guy out there 10 years ago, and 5 years. Let's even go 6 years ago. There was always people that were working out of the back of their trucks that were always lowballing, that always had lower bids, but because there was so much work out there, we didn't really care. We sold on quality. We sold on a reputation. Now, price has certainly become more important. The economy is faltering. And so then the question is, how do we compete with those companies? And that goes back to finding ways to compete on value. And again, I don't do consulting on sales, but finding ways to compete on value and making sure that you're finding the customers and the clients that aren't only going to pick you based on price. So it's a hard answer, and boy, Michelle, I wish I had a better answer for you. But in essence, it's waiting for them to go out of business. It's also finding ways to become more efficient and be able to lower your price, finding ways to pass risks onto the customer, and look at different ways of setting up pricing, look at different ways of including fixed bid versus T&M versus multiple pricing contracts, and to also really take a look at the kind of customers that you're working with and think outside the box on how you can do your pricing. And then ultimately, I always tell my clients there's really only 3 ways to make more money. Really, really only 3 ways in our industry to make more money. The first way is you got to charge more money. Well, for many of us, we don't think that's an option. The second is to spend less. And that, for many of us, is the option, is to find a way to be more efficient, is to have less downtime. I have one example where there's a warehouse, there's a guy that works in the warehouse. The field crews come in every afternoon, 3:30 or 4. They are not allowed to clean out their truck or touch their trucks. Instead, what they have is they have a high school kid who comes in at 3:30 every day, who is his responsibility at $10 or $12 an hour. It's his responsibility to clean out the trucks, restock them, make sure they have the set stock, determine what was used that day, and so technicians never touch their trucks. The field guys never have to do that because what they found is more efficient uses of dollars. So you got to price higher, spend less, find ways to more efficiently use your dollar or increase your volume. But that third one of increasing your volume can only work as long as you increase it profitably. If you start lowering your price to nothing, I could certainly increase your volume, but again, that whole joke, what I lost in profit I made up in volume doesn't work. You have to find a way to increase your volume profitably.
Next question comes from Marty Malinowski, who I think is trying to figure out who his high performers are. His question is, can I determine revenue and profitability by technician?
Absolutely. Absolutely. One of the things to do is, again, it depends on the type of work that you're doing, how much is service, how big your crews are. But one of the things to do is to take a look at your jobs and your profitability, and take a look at, particularly on the ones where the technicians are working individually, take a look at the profitability by job. Again, the more information you have, and this is where an automated system is more important, if you can slice and dice your numbers, I want to do my revenue and slice and dice dice it by equipment and labor. I want to slice and dice it by the technician that ran the job or maybe the project manager. So absolutely, that's where you do want to figure that out and determine, there's a book called Work Smarter, Not Harder. Sometimes you've got those people that are always busy, but the reason they're busy is they're very ineffective. So yes, I think trying to determine your revenue and profitability by technician, again, if you have good job costing and good estimates to see how many hours did you think it would take to do that job and how many hours it did take for that job, that's what's important.
Here's a question from Tanya Pima. How do you determine if you're overbilled or underbilled?
That's a great question, Tanya, and I'm glad that you're trying to figure that out. There's actually a formula, and of course, with a very limited webinar, I didn't have time to get into it. But in essence, the formula says look at what percent of the cost you've spent. If you spent 30% of the job, so you take a look at your cost and you divide it by your budget. I thought I'd spend $100,000. I spent $30,000. I'm 30% complete. You use your cost to determine what percent complete you are. You then take that percent complete and you multiply it times your contract. That's how much you can actually say that you've earned. If I have a contract that's a $150,000 contract, I thought it would cost $100,000. I sold it for $150,000. If it's a $150,000 contract and I'm only 30% complete, then I can, in essence, say I've earned $45,000 worth of revenue. Then I take a look and say, how much did you bill? Did you bill more? You're overbilled. Did you bill less? You're underbilled. Really, that's the simple way to walk through that spreadsheet to determine that formula.
Next question comes from Tom Thompson. Is there a good way to get control of your inventory?
Oh, wow, Tom, what a great, a good way to control? Yeah, fewer employees and not have anybody touch anything. It's, the best way to control inventory is to have a really strict process about how it comes out. The putting in of inventory is quite easy because accounting-wise and physically it's pretty easy, and people don't usually make mistakes. It's the taking out of inventory. I had a company that I worked with put all their inventory behind lock. They put up a fence, and then because it was such a pain, they left the fence open every day. Well, either do it or don't do it. So my suggestion with inventory is that it's an all or none issue. If you do have inventory and you are buying in bulk, you then make sure that you buy in bulk and track every large piece of inventory. The other thing that's important is don't waste your time on the little stuff. Determine on your inventory what's really inventoriable and what's really a consumable, what really doesn't matter that much because the price is small and the quantity goes in and out so fast nobody really cares. What I would say is if inventory is a problem, set up a cutoff and take a look at only the large pieces of inventory to track and stop worrying about the smaller inventory because you're probably, it's sort of the bang for the buck issue, you're probably spending a lot of time and energy on something that isn't really working for you.
Next question, I think Royce Burris is trying to figure out where this above the line versus below the line. Is a labor force from temporary agencies better than hiring employees?
It depends. It really depends on the temporary agencies. The advantage is you don't have to pay a lot of benefits. The advantage is on the temporary agencies that you can, you don't have to worry about letting people go. The disadvantage is you may not have them when you need them, and the other disadvantage is they may not be trained. So you have to, in essence, take a look at the cost benefit. Look at your backlog and look at the type of work that you do. Can you get your employees to be as efficient as possible? Now, if you do pay holiday and sick and have safety meetings and have production meetings, you're not going to get more above too much above 80 or 85% efficiency. But if all your employees are operating at full efficiency, that's where you might want to think about bringing in temporary people until that until you can justify having another person at 100% or at full efficiency. So that's really what you want to do, is you want to take a look at the efficiency of your employees. If they are still operating at a 55% efficiency, why is that? And if it's because there's not enough work for them, that's where you might want to reduce your staff and have just the temporary labor come in when you have need.
I've got to go back to Michelle Skeel because she asks such good questions. She's got a couple that are sort of interrelated that she's getting kind of thrown for a loop with the year-end closing stuff. One question is when she pays corporate taxes at the end of the year, the IRS employs the WIP principle. So that skews their P&L. And the second part of that is, how do we address showing a profit at the year or the end per the accountant's report, but we're deep in a debt hole?
Okay, and then can you repeat that first question?
Yeah, the first part of the question is, when we pay corporate taxes for each year, the IRS does employ the WIP principle. So we end up with a skewed view of our P&L.
Okay, so there's a couple of things. One is that WIP principle should probably be done at least, so you're doing it yearly. It's better to be doing it quarterly, and it's even better to do it monthly. It's better to do it quarterly because that might help so that you're not just having some skewed number at the end of each year. The second thing is that when I do a WIP adjustment, I always reverse it immediately the next day of the next period. So if you're doing a December 31st WIP adjustment, I always go in on January 1st and reverse it, because otherwise you carry it throughout the year and it doesn't make a whole lot of sense. The other thing is that whole idea about who's supposed to be looking at your financial statement. You know, one of the things that accountants or CPAs do is they need to look at your financial statements once a year, and they need to do it for taxes. You, as a business operator, owner, or business in the profession, you need to look at your financial statements every day or at least monthly. So what I try and do is get owners to look at their financial statements for how you can use it to manage your business. Let the accountant do what they do off the books for the tax return. You know, I'm not saying you're going to have two sets of books, but the stuff that they do is stuff for the IRS, or it's stuff that they have to do. What you want to do is stuff that you need to know for better managing your business. So this is where some people come to me and they're like, well, my CPA says I have to be on cash because that's my tax return. And I say, well, then once a year adjust it to cash. But I think if you want to manage your business, you have to be on accrual. And then I get people say, well, my CPA says I have to be on completed contract. And I say, well, then do whatever you want at the end of the year, but to manage your business on a month-to-month, day-to-day basis, do what makes sense for you that will help you manage your business.
Next question is Russ Abels wants to get more information on the WIP process, and he asks, does your book show more detail on the WIP process?
Wow, Russ, I should probably pay you. Absolutely. It's called A Simple Guide to Turning a Profit as a Contractor. It's available. There's a link on my website, or it's www.moneymazebooks.com. And yes, we talk a lot about how you do the WIP formula and how you do the WIP adjustment. So thank you, Russ, for asking that question.
Marty Malinowski has a question. Will this product help me set an appropriate price for service and appropriate service and materials prices based on historical data over the first year or so using it? I think Marty's trying to get as accurate as he can in figuring out his costs.
And so you're talking about the product. I'm not sure which product you're asking about. Will this product help me set an appropriate service? So there's a couple of things. One is you need to have a good software product so that you can get true historical information. So you do need to get historical data. And so that's where you're looking at a good software product that handles your accounting and your job costing simultaneously, is really has the understanding of what you need as a contractor. Then you can also take a look at the labor burden calculator, is just an Excel spreadsheet. That helps you figure out, based on a historical cost for your labor, but that doesn't really help you for your service and your materials. So I think he's talking about the software and sort of what accounting software you want to use, so you have something that's really valuable that will help you. Absolutely take a look at historical data so you can start making those decisions.
And I think we have time for one last quick question. What would you consider labor revenue?
So anything that has to do with either subcontractors, temp labor, or anything that has to do with installation is labor revenue. So if you are anything that you buy and install, the thing that you're buying and installing, the equipment part of that, that's equipment revenue. So I make a distinction between the two because equipment revenue works differently than labor revenue, and your sort of ability to make money and your ability to stay on target is different. Typically, companies don't lose a lot of money on equipment. Although, it's interesting because I have an HVAC guy I work with who had a horrible year last year, and one of the things he did is he lowered his price on all of his equipment, and he actually continued to make money on labor, and he lost money on equipment because he basically was probably like one of you guys, I think foolishly, lowballing so he could stay in business. The problem with that is you can't do that year after year after year. So in essence, what you're trying to do is take a look at something that you purchase and then install is your equipment. The labor revenue is really the labor, the cost to hire that employee and keep that employee. So that employee is generating something. So when you are looking at your package, however you price the services and the systems that you sell, you want to figure out what's the labor component of that and the equipment. And in many cases, there's three components: labor, equipment, and then overhead and profit. So you really want to try and break that out and figure out how you're doing your original pricing and how did you come up with the price that you're charging and the price that you're quoting.
Well, I'm afraid we've run out of time. On behalf of Contractor Magazine, I'd like to thank all of you